ladies and gentlemen. Welcome to The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and I'm very excited to have on the other side of the mic, Haseeb Qureshi at Dragonfly joining us on the program for the first time. I was telling you before we actually got started that there are certain people, and I've talked about this on the show a few times, that I feel like have already been on the show. And you're one of them. We've had, your co-host on the chopping block on a few times, obviously. But I don't know. It just feels like you've been on. But so a lot of the time when I think someone's been on the show, I'll Google the person's name and the scoop to go find that episode. And I couldn't find you, but I did find this Business Insider article from 2016 in which you sort of offered your sage wisdom on how to advocate for a $250,000 base salary in Silicon Valley. This was this was almost this was from your pre-crypto life.
That is correct. Yes.
Which I think presents us an opportunity, since this is your first time on the show, to maybe walk through your journey into crypto. I'm sure most of the time when you come on a podcast, you kind of dive right into it. I know you guys at the chopping block are chopping into issues day in and day out. Let's maybe walk through your story, and then we can dive into some of the issues you see underpinning crypto venture.
Totally. Well, I'll say, Frank, I do also feel like I've been on the show before. So spiritually, it's good to be back, even though technically it's my first time. So I'll give the very brief prehistory. So long time ago, back when I was 16 till I was 21, I used to be a professional poker player. Mm-hmm. That was basically 2006 or 2011. So way before any of this, crypto stuff was even on my radar. Funny enough, that was actually where I learned about crypto first, was from professional poker players. Because so I quit soon after what was called Black Friday, which was when the U.S. Department of Justice shut down a bunch of overseas poker sites that were kind of playing fast and loose with taking Americans as customers when they weren't supposed to. And the professional poker players who I knew, who were mostly playing online, they were no longer able to gamble with a lot of people overseas. And so they started going onto these Bitcoin settled poker sites and settling their debts using Bitcoin. And that was the first time that I really heard about Bitcoin. And it made sense that, okay, here's a way to settle gambling debts over the internet. Mm-hmm. But it never really occurred to me as any meaningfully larger story than that. And so I ended up eventually finding my way into the tech industry, and I became a software engineer in Silicon Valley. Funny enough, I never studied anything technical in school. I studied English and philosophy, which led to me much later in life becoming professionally insufferable and writing way too long blog posts. But other than that, I more or less learned a lot of technology stuff on my own. But I ended up at Airbnb working on payments fraud. And that was where I first kind of got crypto pilled, just because I realized how completely broken the traditional payment system is. Airbnb pays people in, 60 plus countries around the world. And from the perspective of a consumer, you swipe your credit card and magically someone gets paid. Mm-hmm. And in reality, there is no single magical system that pays people. There's like a bunch of different systems, all in different countries, none of which talk to each other. Some of which are like emailing CSVs at midnight that people are manually reconciling. And it's just all a gigantic ball of spaghetti. It's all horrible.
It's very similar to Brian Armstrong's story, right? Like he saw how inefficient it was to accept
That's exactly right.
Across these different jurisdictions.
So funny enough, I actually worked on the same team at Airbnb that Brian Armstrong was on. I actually worked on some of his code. Like he did the very, very early CIF Science integration at Airbnb, which was pretty ugly. It was not great code, but it was a different time in Airbnb's life. So, but that was and I actually met Brian Armstrong. I was at that time, Airbnb and Coinbase, they shared this thing called the Risk Salon, which was a place where a lot of people who worked on anti-fraud would come together and share tips and techniques from some of the top tech companies in Silicon Valley. And that was where I first met Brian Armstrong, Soups, who went to go co-found Sardine. He was the head of risk at Coinbase at that time, and a bunch of people who were early in those days in crypto. And that was what ended up convincing me that crypto was going to end up being big. So I came into crypto full time. First worked at 21, which became Earn.com, which got acquired by Coinbase. That was Balaji's company. Then I started my own startup working on a stablecoin. And then I came on the investing side. So I was first recruited by Naval to go work at a fund called Dragonfly, Metastable Capital, which is one of the
Yeah.
super OG funds. And then I ended up doing Dragonfly. So me and Bo Fong, we ended up building this fund together about 6 years ago now, and been managing it ever since.
What was the, by the way, I'm sure we can have a whole podcast in which we bring on Tom and Tarun and Robert to wax poetic about the extent to which your philosophy background maybe manifests into the insufferable underpinnings of your character to which you're referring.
Correct.
But
Very, very, very correct.
What did the early days look like for Dragonfly? Like, I often hear stories about some companies in the space. The first, few, the origin stories are always so bizarre and interesting, right? Like I remember Genesis, right? Someone, one of their first counterparty meetings, a Russian guy walked into a room and opened up a briefcase full of, $100 bills to do one of their first OTC transactions. My story stems back to the Beekman Hotel, seeing one Mike Dudas sitting in a very shadowy corner of the hotel with a glass of Merlot. What was yours like?
So when I first started at Dragonfly, I mean, this was peak bear market, right? So this was after the ICO bubble had basically collapsed, and it was on its way, just pancaking further. And so at the time that I came into Dragonfly, crypto was not cool. Crypto had already become very, very uncool. And everybody who was in crypto had kind of gone through that dark night of the soul of, is this really what I want to be doing? Do I really believe in this, or did I believe in it because other people believed in it? And that at that time, like nobody invited crypto people to parties. Like it was very different than what it is today, where crypto is like kind of cool and interesting, and it's not quite as fringe as it once was. At that time, we had this small office in SF. I remember it was me, Tom, and Ashwin sitting in this like very small little room. And at that time, also there weren't that many deals, there weren't that many founders. It was kind of, this is before DeFi was even a term. And I remember we were looking at this sort of Gen 1 DeFi projects.
We were calling it open finance.
That's right. That's right. There was, it was Compound was raising a venture round, and we did a deal with MakerDAO. And at that time, the space was so small, and also nobody knew who we were. No one knew who I was, for that matter. So, a few people maybe read my blog posts, and, I was kind of known as being a crypto think boy. Basically, I wrote, a few blog posts describing how stablecoins worked, or describing how, remember at that time, I think it was 2018, I wrote this post about how Ethereum is now unforkable. Everybody at that time, there weren't that many people writing about this stuff. There weren't that many people talking about it in a cogent way. And so we gradually started building a brand and building a name for ourselves. But at first, people thought we were total randos, and it was very difficult for us to get access to deals. It's kind of weird today because now, Dragonfly, we've been around for so long. It's kind of just a function of survival. Is if you just survive long enough, people kind of think you're a big deal, mostly because you just didn't die. And I think so many funds end up befalling the same fate, which is that they end up just, the partners get bored, or they just lose the faith, or they just get too rich.
So what underpins that survival? Because you mentioned, right, it wasn't easy to get, maybe, you weren't sort of hitting every sort of home run in terms of getting in on every deal that you maybe would have wanted to. So what sort of keeps the faith, as it were?
Well, I'd say if you look back to our fund one, I mean, almost every fund of that vintage is amazing, because of course that was like the depths of the bear market vintage. So almost anything you did made money.
Yeah.
That said, there's a lot of dispersion among how much money you end up making in that cycle. But it was funny too, because at that time, it wasn't actually that we couldn't get into things. It was more because the reality was, at that time, that was like the party round era.
There just weren't enough things.
Yeah,
right?
exactly. There weren't that many things, but also like everyone there was kind of friendly. So, Andreessen, they would write a check, but they would like leave room for everybody else. And like Paradigm would also write a check. And then everybody like, hey, you want to write a check? Oh yeah, totally. We'll go down a little bit. It's totally fine. That stuff doesn't happen anymore. Right now, we're very much in the mega fund era.
Is that because there's these other funds from outside crypto that have come in? And so, if you think about a round in 2018, like, not that Paradigm or A16Z didn't have the conviction, but you didn't have enough conviction to just like take the whole check.
Yeah.
Because, it was just so early.
That's right. It was also a philosophical thing that, I think the VCs kind of comported with this idea that things are supposed to be decentralized. And so it's probably even more decentralized if none of us takes that big of a part of the round. And I think at some point, the fund math just kind of demanded that, okay, well, that might be true in principle, but come on, we got to, we got multi-billion-dollar funds. We got to put big checks to work. And so I think at some point the rationale there kind of
Is that
shifted.
what changed? Is just the fact that these funds got bigger?
I think that's a lot of it.
So
I think that's a lot of it.
It's not like the philosophy got.
I think also what happened was that there was less of a kind of kumbaya feeling in the ecosystem, right? So it's an interesting question. For example, in traditional venture, you can't really back competitors, right? That's kind of a no-no. So if you back Uber, can't do Lyft. You do Lyft, can't do Uber, right? Now in crypto, that's not really true to the same extent, particularly for L1s. So if you do, Solana, you can also do Polygon, right? If you do Avalanche, you can also do, Mina or something, right? So obviously, almost every crypto VC has multiple bets in layer ones, but they don't necessarily do the same thing with every single category, right? So if you're investing into ZK rollup, they don't necessarily invest in multiple ZK rollups, but they will invest in multiple layer ones, and to some extent, even multiple layer twos. And so the question, why is this the case? And I was chatting with the founder not too long ago, who was like, why would that be okay if that's not okay for investing in two data companies, right? You're not going to invest in Dune and invest in Flipside. Like that's not cool. So I think the answer is that it is a little bit historical. Like it comes from that first vintage, which is the 2018 vintage, when all the VCs just did all of these different party rounds. And so everybody was just invested in a lot of different layer ones. And that was kind of the Ethereum killer vintage, where a lot of people were telling the stories that we're going to replace Ethereum. And so one, just by historical fact, everyone's in a lot of these deals from that vintage. But then second is also because everybody in crypto owns crypto. And if you own crypto, you own some Ether. And if you own some Ether, are you not conflicted out from Solana because you own Ether? It's like, well, come on, we own Ether, whatever. And everybody owns some of the top 10 tokens because of course you're going to own some of the top 10 tokens. And to that point, it's kind of like, okay, to what extent is it a conflict if you personally hold Ether and you personally hold some AVAX and some Sol that you can't invest into another layer one? It just kind of carves out too little of the remaining ecosystem, right? Where the only person who doesn't own anything that's a layer one would be some TradFi guy who has never made a crypto bet, and you don't want that guy's money.
Yeah, and there's not really a parallel that you can think of in traditional Silicon Valley or venture investing where, I guess maybe you can have a guy that's investing in a Lyft competitor that also personally happens to own in his brokerage account Uber stock, perhaps, but it's not the same.
It's not the same.
Let's look at it on the other side, because this is a super interesting thread. Do you think portfolio companies are starting to care? If I'm a Aptos based DEX or something, am I maybe not going to want a check from Dragonfly if they clearly have concentrated within competitor layer ones at this stage in crypto's life cycle? Or maybe, to put a finer point on it, are portfolio companies maybe starting to push back on this more kumbaya dynamic?
Yeah, so we've had some portfolio companies push back on this dynamic. The reality is that it's in a way it's kind of too far gone of a norm in the industry, and it's kind of been the norm now for coming up on 6 years. Is this idea that we kind of more or less ignore layer one conflicts. I think with DEXs, it's interesting because it kind of also does apply to DEXs. Is that the thing is there were a lot of things that didn't originally. So for example, take perpetual swaps. A lot of people pivoted into doing perp DEXs, right? DYDX started as a perp DEX, but a lot of things ended up doing perp DEXs just as a natural, you kind of wander in the forest and you eventually find hey, perp DEXs are kind of a great business and we should launch something along these lines, right? So for example, we invested in Paradigm, which launched Paradex. We invested in Ribbon, which launched Avo. These are now two of the top 10 protocols. We didn't originally invest into a perp DEX, but they ended up launching a perp DEX. And so just by kind of sheer happenstance, a lot of things end up converging toward what are the most legible and competitive markets, just because the market size is sufficiently big that even carving out a small niche can end up becoming quite lucrative. On the other hand, like, I don't think this is something that is going to go away, because like, at this stage, block space, there's some sense in which all block space is competitive, right? Like, technically you could go build your new protocol on a Bitcoin L2. So technically you could build on Bitcoin. You could also build it on Ethereum mainnet. You could also build it on Ethereum L2. You could also build it on Aptos. You could build it on Sui. You could build it on Solana. Like, all of these forms of block space are ultimately competitive with each other in a narrow sense. Or I should say, rather, in a broad sense. In a narrower sense, you could say, like, well, Solana really does target different kinds of applications than Ethereum mainnet does, right? And ultimately, you're accepting very different trade-offs.
That gets to the controversial tweet that we saw from David Hoffman at Bankless about, he tweeted effectively, like, Ethereum has BlackRock building tokenized funds with Securitize, whereas, Solana's, creating this Cambrian explosion of meme coins. We're not the same, or something to that effect.
Yeah.
And a lot of people got upset about it. But I think there is an underpinning, like, truth to that. Obviously, he was being maybe being purposefully snarky, which is fine. We can all do that sometimes. But I actually think that there's some real truth to what he's saying, which is none of these things they're not going to be doing the same thing. And, like, there is value to, like, what Bonk has done and how that maybe manifests into the growth of Saga, and what just like what we could get out of meme coins. Obviously, there's been a lot of disgusting things happening with some of these meme coins. But I actually think the dichotomy he painted is one that is real and good. Yeah.
I mean, look, to be clear, I completely agree. So one of the blog posts that I've gotten that's gotten the most love is this blockchain as cities analogy. And
that's why I think you've been on the show, because we talked about this, and I could have swore I actually think you might have been on the show.
I think it might have been deleted. Yeah,
that is exactly what happened. That's what I thought of when I was preparing for the conversation. We had a conversation last time about blockchains being cities, and I just couldn't find it. Maybe this is just a search issue. I could have, I read this blog post, but I think it 100%. 100% relates to this sort of idea of the crypto world that you've kind of,
Exactly. So, like, there is a sense in which, like, Manhattan competes with Venice Beach, right? They are both literally real estate, and they're both places where you could live and you could start a business there, and you could take your, your consumer dollars and go spend them there. But what Manhattan offers is as different as it could be from Venice Beach. And it's good that they are, right? In some sense, it's almost predictable ex ante that the two biggest cities in the US would be as different as possible, because they service a very different kind of person, right? So, like, if you want to live in New York, you've got the gloomy weather, it's cold, you mostly work, you drink a lot, right? It's just like, it's very, very, you're kind of dark and disheveled, and, like, that's the vibe in New York. Whereas LA, it's like, it's shiny, it's beautiful. Like, look, let's just launch some meme coins. Everything's super cheap. Like, why are you guys so worried about decentralization? Like, get that stick out of your ass.
I think that dichotomy is represented in the difference between our two aesthetics.
a little bit. Yeah.
A little bit.
I think, but to be clear, I think that's healthy. And I think, David Hoffman said that in a sneering way, but I don't think you should have. I think you should say that in a way, in the same way, one might say that about New York and LA. It's like, oh, this guy in his jorts, I don't know, rollerblading down Venice Beach.
But it's also like okay to say it in a sneering way, because it's like almost
it's fine.
Part of human nature, right? Well, like, like I can make fun of San Francisco with all due respect, whereas San Francisco can make fun of New Jersey people.
Yes.
And that sort of joking, reveals the uniqueness of what both places in this analogy have to offer, as well as the uniqueness in what these different blockchains have to offer.
Exactly. And that's why I think in the long run, although again, there is a broad sense in which all block space competes in the same way that all cities compete, but there's a narrower sense in which they really don't. And in the best versions of themselves, they actually carve out very different parts of kind of culture space and physical space, such that it's not just that, okay, the weather in LA is better than the weather in New York. everything about the way that city is built is very different than the way New York is built. And it's intentional. Everything about the way it's governed is very different than the way New York is governed. And that's intentional. And I think the same thing will ultimately be true for the blockchains that succeed. It's not that they out Ethereum. I don't think that's your job if you're building a new layer 1 to out Ethereum. And I don't think you can. Ethereum is the most Ethereum that any blockchain could be. I think your job is to create a new and different part of the universe of trade-offs within blockchains. And Solana has done an absolutely incredible job at that.
At what point, though, do we sort of say, I mean, this is a weird way of asking the question, enough is enough in terms of new layer 1s being rolled out and actually start getting into the building of applications on these things? Because, and this is a very VC question, right? Because a layer 1 that's successful and becomes the New York or becomes the LA is going to have the most upside for your portfolio.
Right.
But so does that incentivize founders and entrepreneurs to just continue to try to be the ETH killer?
Yeah.
The Solana killer 2.0, 3.0, 4.0.
Yep. So, I mean, I would object to the form of that question in two ways.
You can.
One, if you take the city analogy seriously, it's like asking this question, like, okay, when are we going to have enough cities? When can we finally say, hey, guess what? New York is the biggest. Fuck off with your new cities. Enough. We don't need any more cities. Right? And the reality is that, again, not every city is trying to be New York, nor does it need to be New York to be substantial. So, what you see among cities is that there's a power law distribution. New York is way bigger than LA. LA is way bigger than Chicago. Chicago is way bigger than Houston. But, it's not as though if you're like San Francisco is like number 12 of the biggest cities in the US. It's still a really friggin' important city. Same thing with Austin. Same thing with, a lot of other cities in the US that carry global weight, but are nowhere near the list of the top cities in the US by number of people or even by sort of GDP. Now, if you look on the other hand, the basic question of like, okay, well, that fine, cities, okay, but you're kind of running loose with the analogy. What about blockchains? And there I would give you a more direct answer, which is that clearly blockchains still suck. They still suck. It's been basically 7 years, almost 8 years now that we've had smart contract platforms, and they suck. Ethereum is super expensive. It's super slow. Barely anything has changed in the last 7 years since we originally launched Ethereum. Yeah, P4844 and some opcodes have changed, right? Like even Solana, very ambitious new vision for what a blockchain can be. Go try Solana right now, right? Like people are setting 50% slippage limits so they can get their transactions included. Otherwise, transactions are getting dropped. Like everything's a mess. The RPCs are falling over. The reality is that we are still very early in this technology. And crypto is technology. Crypto is fundamentally technology. And all technology gets better. It had better fucking get better. Otherwise, it's going to lose. So if your technology does not get better fast enough, it will get superseded by something else that does. And so my view very simply is that it is not zero sum in that, well, we've got too many people building layer 1s and therefore no one can build applications. That's bullshit. Obviously, anybody can build an application if they so choose. But the idea is that like, hey, we have too many people building infrastructure. Are we sure about that? Because right now, what I see is that Ethereum fees are basically like $20. And I see that Solana is, has a transaction failure rate of 50%. So it sure looks like the infrastructure we have is not good enough for the demand level that we're at right now. So that is why I am not so on board with this story that there is an undersupply of applications and an oversupply of infrastructure. It will always be true that most infrastructure doesn't work. In the same way, most people who've written operating systems, nobody used their operating system. They mostly use Windows and Mac. But the amount of innovation that has gone into operating systems is billions of dollars of R&D that have gone into getting Windows and OS X to where they are today. And as they should. And as they should continue to.
So is that what's going to separate the great crypto venture funds from the ones sort of forgotten about in the dustbin of venture history, the ones that pick the right operating system?
I think it's one part of that overall story. I mean, this is something that we've been doing for a very long time, right? So, I invested in the seed round of AVAX, seed round of Near Protocol. We led the seed round of Monad, which is kind of one of the new layer 1s that people are excited about. We did the seed round of ZK Sync. We've been investing in infrastructure for a very long time. And it's a space that every cycle, people always ask the question of like, isn't this enough? Ethereum killers, do we really need to kill Ethereum? Is Ethereum that bad? And then after the Ethereum killers launch, okay, well, we already killed Ethereum. We already have all the Ethereum killers. Or, Ethereum will never be killed. Why are you investing in this stuff? And now we have this new version of this story. And I think the answer is simply that I don't think in general that infrastructure is undersupplied. I think if anything, it becomes clear every bull market that we are a factor of, either 10 to 50, depending on how you count, undersupplied on infrastructure. But the problems that we need to solve are very hard problems. These are basic science level problems of how can you get a blockchain that maintains decentralization, but can scale by 20, 30, 50x. And we don't really have a good single answer for that. Like we have an answer like Solana, which kind of obviates a lot of what we traditionally think of as being part of what a blockchain does, right? So we eliminated the mempool, we eliminated light clients, we eliminated Merkleization. And that gets you a lot of headroom that can allow you to move really, really fast relative to most of the blockchains. But it still doesn't get you to the finish line. And, Anatoly is the first to acknowledge that like, hey, we can't scale another 10x, right? We are basically at the point where this is about how much Solana can do at present day. And I think that's going to be true for every blockchain in short order.
What does the future look like in terms of as sort of this space matures and winners, the winners become clear and the losers become clear? Is there do those ecosystems die? Do they get acquired? Are things like that possible? How do you sort of, if we're still very early in this infrastructure experimentation phase that you're describing, and in fact do not have enough infrastructure, how do you see the process of consolidation maybe playing out? Will it be like how there are hundreds of cities in America, or I don't think you can have hundreds of blockchains, but we don't need to.
I have bad news for you.
Is that what happens?
I mean, I just looked up IOTA. IOTA is number 110 on CoinMarketCap, still has $1.4 billion fully diluted valuation. I have not heard anyone say the word IOTA in a few years. So
that's the Tangled. That's the Tangled blockchain network.
The Tangle. Oh yes, you remember the Tangle.
I remember. Yeah.
The Tangle. Oh yeah.
I think I
before AI was the hot thing. IoT was the hot thing.
IoT.
That was 2017. Yeah. That we were all about the IoT chains, and IOTA wasn't the only one. There were several others. But okay, so look, in crypto, obviously there's no such thing as bankruptcy for a layer one, right? So there's no going to zero for a blockchain. As long as there's some bot somewhere out there that's willing to trade this thing back and forth, it will continue to exist. We can, this is sort of the existence proof that that is just the case. I don't know. I mean, that said, if you hold $100 million of this, you're never getting it out at this rate because, I don't think that liquidity exists unless you're going to TWAP it for the next decade. Mm-hmm. But I guess my answer more or less is that,
sorry, IOTA whales.
I don't know who I'm calling out here, but best of luck if you're trying to get out. My overall take is that I do think it will be the case that most of the attention, most of the energy is going to be focused on a small number of chains that are really working. If you're in a chain that kind of loses the game, it's not as though it's going to go nowhere, right? There are a lot of cities that aren't growing in America, and they sit around and they continue to be cities. And it's fine. I think there will be, with enough time, there will be more dispersion among blockchains, such that there are things that go close to zero, but they will never be quite exactly zero because there is no forcing function to drive a blockchain to zero. You can drive a company to zero because their assets will be less than their liabilities at some point, and they have to pay franchise fees to Delaware in order to, blah, blah, blah. But blockchains don't have to do any of that. And so as a result, as long as there's at least, 4 nodes, you can run BFT consensus and technically the blockchain can stay online.
It's a really good point. I like this sort of theme of thinking about the evolution of sort of this space and how things have changed. This is kind of what started our conversation before we turn on the mics was this idea of points. This is relatively new. I've been point pilled. And we talked about how before we turn on the mics, we don't necessarily need to get back into it, but let's maybe walk through how do you sort of talk with founders and projects about thinking about these different types of tools in their toolbox that they can use, um, and yeah, I guess just to put a finer point on it, why do you think points are so useful?
So if you think about what predated points, how do you end up distributing your token to retail? And how do you end up incentivizing the right thing on your protocol? So way back in the day, it was ICOs. Obviously, ICOs are now basically illegal, although they've come back in the form of these meme coin pre-sales. That's right. But ICOs not really a thing anymore. Then you got to the DeFi world, and with the advent of DeFi, you got into liquidity mining. And liquidity mining is kind of you can sort of think of it as it's an airdrop over an integral. And what is the thing that you're airdropping to? You're airdropping, a tiny amount of capital every minute to people who are doing some action for you. And so that action could be depositing into an LP pool. It could be, providing some kind of backstop for something, right? That was liquidity mining. And the problem with liquidity mining is that, well, in the early days, people thought liquidity mining was a genius innovation. But the reality was it caused a lot of cavalier capital to come in and, come mine the liquidity mine some particular protocol. And then as soon as they collected the rewards, they left. And most protocols actually don't need just mercenary just-in-time capital. What they need is long-term liquidity. And it turned out that, when liquidity mining became better and better understood, that liquidity that you were buying was not sticky. And if it was not sticky, it was actually not valuable.
Can't we just think about this as like insanely expensive customer acquisition?
Yes. I think the better way to think about it is as basically paying an interest rate to capital. So, you can think of it as a customer. And I think in the very early days, it was right to model it as a customer. But at scale, when liquidity mining really got going, it was no longer about customers. It became about capital. You're renting capital. And how much are you paying to rent capital? Well, that's an interest rate, right? Interest rate is the cost of renting capital. So they had to pay very high interest rates because they were paying in their own shitty tokens. And nobody wanted to hold their shitty tokens. And so you had to pay a very high interest rate if you're giving me this interest in your shitty token. So
and the shittier the token, the higher the interest rate.
That's right. So all those,
pickle
10,000, 30,000, 4 million APY, those APYs were in tokens that people were pretty sure were never going to realize those actual returns. So all of that,
anyway, continue.
That was Gen 1, right? So that was early days of DeFi. And what you see in all of these iterations is you see this adversarial game. Is that you have the founders or the teams who are trying to incentivize the right thing. Then you have
the mercenaries,
the mercenary capital or the mercenaries who are adapting and making sure that actually you want this thing. I'm going to give you this other thing, which is mercenary capital instead of sticky capital, or users or capital instead of users, right? And so then you had the airdrop season. And with airdrops, you basically, you can think of the Uniswap airdrop or many of these other airdrops, which is that you use my protocol once, I take a snapshot at some period in time, and I give tokens to everyone who used my product as of some period of some date. And in the early days, like if you think of the Uniswap airdrop, these were the users of Uniswap. These guys really were the people who supported Uniswap in the early days. And they may have even created some net retention from airdropping to these users. Now, there's actually not much evidence for that. There's been some people who've done some good data science to show that almost everybody who got the Uniswap airdrop just sold and never participated in governance. But there's at least a good theory of the case of why it might have worked and why it might have been sensible. And then you get this, once this happens enough times, you get airdrop farmers. And airdrop farmers, they understand the metagame, which is just use every protocol at least once, 3 times, back and forth, and spend at least $100 because that seems to be the threshold at which people cap these airdrop programs. And so it got to the point where there was so much adversarial behavior that of these people basically farming and creating this fake or inorganic activity to look like real users, that airdrops no longer really worked, right? Most people you're giving airdrops to were these industrial farmers.
Did anything work about them? Did anything work about them in hindsight?
I mean, I would argue that not very much about airdrops actually worked, except insofar as they distribute the token. And distributing the token is important, right? You ultimately need some way for normal people to get access. Yeah, to get access to tokens and provide some float out there and some price discovery and also some people to participate in governance. And so it worked in that regard. But in terms of, did you actually strengthen your metrics after an airdrop? And the answer, as far as I can see, is almost every case, the answer is no.
So, and this is the point I was trying to make very
Hmm.
without eloquence before we turn on the mics, is that points sort of provide projects with the ability to maybe weed out or limit the impact of this mercenary capital.
Right. They do that not just once. So, many airdrops would actually go through before the final airdrop, and they take the snapshot, but then they also weed out from the snapshot, like, these guys look like they're farmers, so we're going to delete them from the airdrop, right?
Mm-hmm.
And the nice thing about point systems is that point systems are even more flexible because, one, in a point system, you basically pre-announce what you're awarding. And if you pre-announce what you're awarding, then you see all the adversarial behavior. You see how all the bullshit artists are adapting to the point system that you have laid out. And you can see, oh, wow, okay, these people are doing something totally useless, and that is actually not beneficial to us in any way. And these people are doing something that's actually useful. So what we'll do is we'll move the points away from here, and we'll start incentivizing more points over here. So you can adapt, you can iterate.
Yeah.
And this iteration allows this, this adversarial game. It used to be that basically it's kind of like the tax code, right? Imagine that the tax code could change every month. I mean, obviously this would be horrible for you and I, but it would be great for the government to be able to respond to, like, oh, people are using this tax loophole. Let's immediately go and change it so that you can't use this tax loophole. And then they'll go find some new tax loophole. And then you say, okay, we're patching that too. Instead of this taking years to run through Congress and getting these big exactly. And so that's basically how old school airdrops worked, right? Old school airdrops were like a fixed tax code, and you see I can create a trust in my children's name and put in the BVI and do this weird, reverse ownership structure, and boom, now I don't pay any taxes. And you have like 5 years to just do that.
To fix it.
Yeah, and you're basically kind of fucked if you're the protocol. You can't adapt to the fact that people are messing with you. And now with a point system, you can. And that, I think, is the real beauty of the point system.
There are probably hundreds of examples of Peter Thiel investing in startups through his 401k untaxed in the crypto world.
Exactly. So this is the best analogy I can give for why points they give so much power back to the teams to be able to respond to all the adversarial behavior among the industrial scale farmers.
And like I said, I just aspired maybe to be a bit more of a mercenary, and I never really had it in me, but
I think you can get there.
I sympathize with that.
I believe in you. I believe in you, Frank.
Okay, so I want to let you go because I know you've got a bit of a cold, but where can we maybe wind down the conversation? What are you anticipating over the next 6 to 12 months in terms of crypto venture? Maybe we can just start with valuations. They seem like they're a bit frothy. Are they? And how are you approaching this market given the macro backdrop, everything that's happening?
The valuations are definitely on the uptick. I would say the frothiness is unevenly distributed. So there are some deals that are very frothy and some deals
it is,
that are
isn't it?
reasonable.
Like all the old private companies, since we're doing so much history, the 2021 unicorns, have you heard anything from them?
No.
Like, but meanwhile you have these seed or Series A's raising at $500 billion valuations.
Right, exactly.
Meanwhile, the unicorns of 2021 are crickets.
Yeah, just sitting on the shelf.
Anyway.
No, yeah, I think that's right.
I don't know if that was the direction.
I think that's right. And so, but I think it's also true even at the seed round is that there are some deals that are being priced in a sort of insane over the top way, especially when it comes to crypto AI. That's where I'm seeing the most frothiness of just lots of really nuts valuations at seed and pre-product startup raising at multi-$100 million valuations. So things are definitely getting a little nutty there. I think there will be, every crypto bull market has kind of fits and starts. And we're already seeing that, there's been a pullback from 70 plus down to 62, I think today. And that's normal. I think we're going to see more of that, this kind of sputtering in the crypto markets. And I think it's also true on the venture side is that there will be these kind of crazy rounds and there'll be a lot of reasonable stuff that's happening at the margin. I think as investors, my overall take is that you want to keep your head on straight and you want to make sure that you're backing serious people, building serious things. And the other thing is that enterprise price matters. So there are a lot of great founders who, unfortunately, we're just going to have to say no to. And it's not because I don't love what they're doing or I don't think they're amazing, but just that as an investor, I get paid on risk reward. And there are some investors in the space who I think are very price insensitive, and they're very pro-cyclical. And so when things go nuts, they try to match the music and they throw diligence out the window. And we don't tend to operate that way. And I think it does us well when it comes to the end of the cycle. But it does sometimes mean that we don't get invited to all the parties.
Very well said. Well, thank you so much for joining the program.
Absolutely. Always great to chat with you, Frank.
And the Scoop will be back for you again with another great guest. Have an awesome day.